Action.
Hello and welcome to InsightEdge, a CareEdge podcast series. I'm Rajani Sinha, Chief Economist at CareEdge, and I have with me Neelkanth Mishra. Neelkanth needs no introduction. And today we're going to talk about Indian economy in midst of this complex global landscape. So we are going to cover everything from trade war to China plus one opportunity, India's sovereign rating, future of jobs in India. So we're going to join all the dots. And thank you so much, Neelkanth, for joining us. Neelkanth is the chief economist at Axis Bank and he heads global research at Axis Capital. Neelkanth, let's start with your personal journey. I know that you grew up in Steel City, Bokaro, and I grew up in another steel city, Jamshedpur. And I know that when we were growing up, the only two fields that people spoke about was engineering and medicine. And in fact, you went to one of the best engineering colleges in India, IIT. So from IIT to where you are today, tell us, how did economics happen in your life?
Well, thank you, Rajani, for inviting me. I think it's always good to catch up with old friends and on important topics. So I would say I'm kind of an accidental economist. I think the first step was, of course, I've always been interested in economic issues. Around 2003, when I was with Infosys, one of my friends who was with Credit Suisse First Boston asked if I would like to consider joining CSFB for being an IT services analyst. And I said, I'm thinking of doing an MBA, but I've never studied finance. He said, it's okay. So long as you have industry experience, you'll be able to be mine. So I tried, they selected me. So I joined Credit Suisse, First Boston in Singapore. And through a series of, I would say, accidental development. So I was very quickly asked to start working on semiconductors. So I started transiting to Taipei very frequently. Eventually, I went to Taipei, stayed there for 2 years. When I got married, my wife's a doctor. I couldn't work in Taiwan anymore because she couldn't practice there. Thankfully, CSFD was starting off in India. So I came back. I became at some other sectors. 2010, they were looking for a strategist because the head of research had left. And they asked me if I would like to do strategy because I'd done so many sectors by then. I guess they figured I could pick up very quickly. And again, after that, I had a lot of curiosity about how currencies move, how inflation changes, how important fiscal is, and intense reading. So over a period of time, as I kept putting out these thematic projects, I must have added value. So the research became popular. 5-6 years later, I started getting called to participate in some government committees. Started with the Revenue Neutral Rate Committee of the GST, then the FRBM Review Committee, then the 15th Finance Commission. And then 2019, I got the honor of being part of the Economic Advisory Council to the PM. By 2018, I'd also become the Asia strategist for Credit Suisse. So all through this time, just curiosity. Economics is a fascinating field. When you're a practicing one, so you would know there is everything becomes important. History, international trade, geopolitics, currencies. So there's so many fascinating problems to solve that I just kept reading. And so I've never had any formal training in economics, but I quite enjoy doing it.
Hey, interesting. So, Neelkanth, you wear multiple hats. Like you mentioned, apart from your role at Axis Bank and Axis Capital, you are a member of PM's Economic Advisory Council. You are a part-time chairman of UIDAI. You are a part-time member of TRI and many more hats. So, I'm not going to ask you how you juggle these multiple responsibilities. In fact, what I want to ask you is, what else apart from work do you enjoy doing? And what's your mantra of work-life balance?
So it's important when you treat your life as very objectively, is to identify your priorities. So the priority of your own health, which of course is extremely important if you have to take care of your family. So those two things comes first. That are you spending enough time with your children, with your wife, with your parents? In the process, are you taking sufficient care of your health? I mean, not to be, as you can see, I'm not like supremely fit or the way I would like to be, but at least retain your health for long enough. Even from a professional perspective, I realized that just like in investment, they say compounding is very important. If I'm today able to read, say, a book a week, say 50, 55 books a year, and I can see a few years of doing that, how it has changed the way I think, just how made me wiser than I used to be. I can, if I can sustain this for another 10 years, then I can start to see patterns which I don't see right now. So that very much is my priority. So when I see, so most of the work on Aadhaar, on the India Semiconductor Mission, on TRAI, all of that happens mostly on weekends when the kids are out playing basketball or something. So I set time slots, and my family has been, I think, very cooperative in that. They also then, like Sunday mornings is with parents, Saturday mornings are with kids, Saturday after evenings are with wife. So there is you have to categorize that, otherwise something or the other slips. And then kind of, as they say in Parkinson's law, that work expands to time, fill the time that you have. In my case, work shrinks into the time that that I have.
So did you say 50, 55 books a year?
Yes, a book a week is my time.
Wow, that's very impressive.
Yeah, and again, so that's something that improves with practice. It's like running. So when you start running 1 kilometer, 2 kilometers, it looks hard, but once you become regular, then you start thinking 10 kilometers just passes by. Marathons are much tougher, but it's the same with books. That when you start reading, there's a way you can read. Plus, what you realize is that a number of books have a lot of repetition. So suppose I'm reading about behavioral economics. The basic concepts of behavioral economics. I mean, first you read Kahneman, Tversky's Thinking Fast and Slow, or maybe some books by Richard Thaler. Most of it will be repetitive. And then that, if you're mostly, I do a lot of audible reading. So you can even at 3 times speed, you can sort of keep going through it. When you find something interesting, you slow down, you say 2 times speed, take some notes. And the rest, when you can read actually very fast. Same with even reading books that once you say if you're reading a book on, say, I'm just finished reading a book on Tanish, the history of how gold regulation happened, how retailing changed, and all that. So there are lots of areas where you kind of know the cast characters. So you can then skip to the stuff that you like. So you can actually read very fast. So the more you read, the faster you read.
I think that's a very good messaging to Gen Z, I would say. Keep reading. That's very important. Keep learning and growing.
Absolutely.
Now, let's come to economics. There's a lot happening in this field, and I'm sure our listeners are very eager to hear your view. If you look at the global economic landscape, it's very turbulent. On one side, we have this high tariff imposed by US. The geopolitical conflicts are still ongoing. There's concerns around dumping from China. India is in talks with US for some kind of trade negotiations. We are also talking to EU. At the same time, the government is trying to push up consumption demand in the economy. But broadly, what would you say? What should be India's strategy in midst of this trade war, and more importantly, in midst of this changing world order?
The most important point here is how can we make ourselves more efficient? So remember, all through these trade barriers, tariff barriers, currency shifts, I think, in the next 6 months, 1 year, 2 years, 3 years, I think we'll see a lot of currency volatility. So as we go through some of those, we have to keep in mind that it is our own competitiveness, how good we are at marshalling our resources, how easily can entrepreneurs build businesses, how cheaply we can build good quality housing, how can we reduce regulations which are currently constraining our entrepreneurs. I think those need to be our priorities. If we do those things, frankly, wherever the currency is, wherever the tariffs are, I think will matter less. To give you perspective, let's look at what the US administration is trying to do. It has been elected because of severe inequality in the US. The MAGA crowd is mostly, there are many people who voted for Trump because they hated the Democrats. Of course, that can swing very quickly. But the core support base of the MAGA crowd is, white, non-graduate males or families like that. And it is because manufacturing jobs have gone out. It is because inequality has worsened. They have lost the ability to fight hot wars. So, in case there was a in U.S.-China war today, the U.S. cannot make penicillin. It cannot make many of the materials needed for armaments. Their steel making has shrunk. So they want to address some of those challenges. So as we think about trade wars and tariff wars, remember that this is just the first salvo. President Trump has this incredible ability, be center stage, make it all about himself, make his topics the most relevant topics for the rest of the world. But those may not be the most important topics. So as you think about the US-India relationship and people talk about 50% tariffs, I mean, really, is that any even worth debating? Because goods trade is a very thin sliver of India-US relationship. So unless America is thinking of a G2 kind of world where they and China kind of rule the world and they split the world into you control this, I control that, which I don't think is the game here. Think about all the ways in which the US India relationship works. It works with services. There is so much of joint work to be done on defense. There is so much of AI related work. There's so many global capability centers. Intel has 30,000 chip design engineers in India. Nvidia has engineers in India. Meta, Google, Amazon. I mean, all the big powered companies in the US have very strong relationships. So apparently, when the Indian delegation had met the US Vice President, he talked about the importance of India and US working together on AI, on regulation, on development, and all that. I'm reasonably sure that in a few months' time, all of this bargaining and grandstanding and brinksmanship that is happening right now will have faded into the background, and those issues would be coming to the forefront. What I think is also important is that the tariffs are not going to work. You know, and I know. I mean, when we think about and we start debating economic issues, we may have different opinions on a whole variety of issues. But one thing everyone is reasonably clear on is tariffs don't work. So in 3 to 6 months' time, if President Trump realizes, when he realizes, not an if even in my mind, that tariffs are not working, that actually consumer prices have gone up, or that manufacturing isn't really coming back to the US, what will he do? And there is enough of a history of that. So when US presidents or any leader of a large country comes to power and tries to solve big problems, they tend to try out things before they settle on the right solution, or the right solution sort of discovers them. I'm reminded of this experience that FDR had when he came to power in 1932, 33, when in order to push up corn and cotton prices, he started buying global gold because some agricultural economist had told him that when gold supply goes up, corn price will go up. We tried that for 6-9 months, and in the way he went about it was actually quite silly. He would set global gold prices from his bedside every morning, and because we thought that buying a lot of global gold will push up corn prices in the US. Finally, it didn't work, and 9-12 months later, finally they did the classic the dollar devaluation when gold went from 20.67 to the ounce to 35 to the ounce. That too, when they did that, a lot of foreign countries started buying dollars. The US monetary base expanded by almost 10% in a month. And then suddenly inflation came back and a lot of the problems got solved. The problem did not get solved because the US administration intentionally did something, or they thought it would play out this way. They kept trying some things and something clicked. In the current case as well, it is unclear if Trump tariffs are legal, constitutional. That is still being challenged, questioned. I think we should be reasonably sure they're not going to work. So I would think that Indian policymakers, and I think they're doing the right thing by not engaging directly, realizing that this is more bargaining and realizing that this is a much more longer term, much more broad-based relationship. So we shouldn't just think about tariffs like that. I don't think they'll be that impactful.
So, in midst of all this turbulence, there are opportunities for India. And in fact, post-COVID, we've been talking about, China plus one opportunities. We did see some increase in FDI, but not in a very big way. So, what would you say is really constraining India as an attractive investment destination? There's a lot that's happening on the regulation front. There is a move towards improving the ease of doing business. But what else needs to be done?
We are working on the ease of doing business. So, for example, the Jan Vishwas Bill 1, now there is a Jan Vishwas Bill 2, which has been introduced for decriminalizing many of the potential violations. A number of regulations are being eased. That's being also passed through to the various states. But we just need to do it faster. If there are still, tens of thousands of regulations and tens of thousands of filings that people need to comply with, when foreign businesses engage with India, it's not enough to get the central government on your side or even the state government on your side. You actually go on the ground and then you start struggling. That even if the chief minister has approved it, the ground level bureaucracy is still resisting you. So, so there needs to be a lot of deregulation. There needs to be a lot of clarity on the tax side. I think indirect and direct tax structures are still very opaque, very prone to exploitation. And that really scares foreign firms when they are. See, because for most foreign firms, and especially given how easily they were able to operate in China, and to some extent how relatively easy it is to operate in, say, Vietnam, they really struggle with the fact that India's structures are actually quite more complex. But that I don't think is by itself, the biggest bottleneck. I think a number of firms can actually start dialing into India because of the Indian domestic demand. In fact, when I was still with Credit Suisse back in 2018-19, I had done a survey. The China Plus One theme was emerging after the Trump tariffs. We surveyed the top 100 global firms with $1 trillion of sales. Nearly 3/4 of them said that most of our manufacturing in China is for China. So the fact that a large part of Chinese exports in the early years were by global firms, of course, helped China grow by 10% for the first 5-7 years. But most of the demand growth that happened in China after that actually happened because of domestic demand. So the fact that Chinese electric vehicles are so dominant globally now is because the Chinese local market is now 60-70% larger than the US market. So the scale, the opportunity to experiment, to try out new products, perfect them in a very competitive environment. I think those are things that we need to build in India. And once that starts to happen, I'm reasonably sure that, given the really large size of our market and the growth that is possible, a lot of FDI will start happening. But I would say that at the first step, we have to control regulations and bring down regulations much faster than what we've done so far.
So yeah, you're absolutely right. India has this huge market, which foreign investors would be very much interested in. And even on the regulation front, like you said, there's a lot happening. But yes, if it moves faster, that will really help. Nikhil, let's talk about India's sovereign rating. So recently, S&P has upgraded India's sovereign rating to triple B. And there's a lot of talk around that, and there's a lot of excitement around that. And as you would be aware, we at CareEdge Global, we kind of, launched our sovereign rating last year in October. And we have in our portfolio some 39 countries, including India. And we have given a rating of triple B plus to India, which was 2 notches higher than what other global rating agencies have given, and which is still 1 notch higher than what S&P has given now. And I'll tell you broadly what our assessment was based on. Basically, if we look at India's economic pillar, India has this advantage of being a large economy and recording good growth. 6.5% or so easily we can expect for the next 5 years. There's a lot that's happening on the capex front. Now, if I look at the central bank, they are doing their job well. Inflation is in the target band. Banking sector health is in a good shape. Look at external sector. It is being supported by robust services sector export. Our external debt is low. Forex reserves are good. If we look at the fiscal pillar, that's an important pillar. And here also there's fiscal consolidation happening. In fact, India will be one of the very few economies where debt to GDP is projected to go down going forward. Whereas for most of the economies now, it's going to be on an upward trajectory. Moreover, most of the government debt is domestic in nature, and more importantly, India has never defaulted in the past. There are some concerns like our interest payment burden is very high compared to peers, but taking all these factors into account, we have given a rating of triple B plus to India. How do you perceive India's sovereign rating? What's your assessment?
Oh, I completely agree with all the arguments that you mentioned, and I'm reasonably sure that the global rating agencies will start coming closer to where you are, maybe going forward. What we tried to do was look at what is the comparison in terms of yield spreads versus the U.S. Treasuries. U.S. Treasuries, frankly, themselves are quite risky right now, in my view. But a point being that if you try to map where India's yield spreads are currency adjusted, and then look at which countries map close to that in terms of rating. At current yields and the yield spreads, we are already almost as good as an A minus. So the markets are, in a way, rating us even higher than what you are rating it at. And I think that is the way generally things move. So when the government was asked, when they embarked on this fiscal consolidation exercise, the the question was whether you're doing it for the rating agencies, and will this be enough to satisfy the rating agencies? I mean, and I have it from like the CMO's bureaucrats who were driving this initiative said, we are not doing it for the rating agencies. We are doing it because it's the right thing to do. And so I think that directionally you're absolutely right on all the fronts. The G-SECs, once the currency clarity emerges, are among the safest assets in the world right now. So even the U.S. Treasuries, given what's really happening to the FAB math in the U.S., the fact that the U.S. wants to devalue the dollar by at least 20-25% over the next 3 to 5 years, the fact that there may be competitive devaluation of currencies the world over, the Indian G-SEC may be among the safest assets in the world. And courtesy the remarkable discipline that the Indian government has shown, it is on the only large economy where even the fiscal deficit has seen a decline from COVID levels. So even China today, at the general government deficit level, is at COVID year levels. US, Europe, all of them saw some bit of a decline because COVID year spending for them was really exceptional. But after that, they've seen a bit of a rebound. India has been steadily whittling down its fiscal deficit. So what that has resulted in is the lowest costs of capital in India's history, which is very powerful. See, the temptation I see among many investors and many commentators is that, oh, we're doing too much of fiscal tightening. I think we need to be a bit patient. So Indian entrepreneurs have been struggling with excessive regulation, excessively high cost of capital. And the cost of capital was high because the government used to be profligate, used to surrender to the temptations of any democratic establishment that you need to give this, you can't cut that. After a lot of effort, the government has managed to bring down the debt to GDP despite COVID pushing it up a lot. And so the cost of equity capital, the cost of debt capital, the regulations, the corporate tax rate, all of them are much lower than what we could imagine 5-7 years back. So this is a great time for entrepreneurs to flourish. And so from a medium-term sustainability perspective, I would say that even the triple B plus that you have may need to be upgraded once we start seeing some of these trends.
In fact, I would like to kind of highlight to you the robustness of our model. We, as I told you, we have looked at some 39 economies. And in the last 10 months, we have seen that for 13 of these economies, the rating by other rating agencies, global rating agencies, have moved towards our rating.
Awesome. Great.
So it just shows how robust our model is. Now, we spoke about a lot of positives that's happening in Indian economy. But one of the big challenges I see is the need to create ample jobs for the large workforce that we have. So, on the one end, we need to create enough jobs. And on the other end, we need to ensure that the workforce that is available is adequately skilled to be able to absorb in the jobs that are available. So, what do you think? Again, on this front, also, there's a lot that has been happening. What more needs to be done on this front?
The first, somewhat depressing conclusion I have is that we won't be able to create all the jobs that we need to create. So we will end up wasting a significant part of the demographic dividend that we have. Let me explain what I mean by that. So we have about, 80,000, 80 lakhs to 1 crore people joining net increase in the 15 to 64 age group, which is the workforce. On top of that, we have 22, 23 crore people in agriculture, producing less food than 40 lakh people do in the US. Now, assume that we are uh, we are going to be relatively inefficient. We don't have large tracts, but still, there is, in my estimate, at least 15 crore people who are extra. They call themselves farmers because they have nothing else to do. So it's classic underemployment. And so, if you want to find jobs for them, say over the next 15 years, that's another 1 crore jobs that you find every year. You have extraordinarily low levels of female labor force participation in India. I'm not even saying that we get to the Vietnam levels of 70% plus, but even if you get to a reasonable number of, say, 50, 60%, 55, 60%, you need to create another crore jobs a year. So I think creating 3 crore jobs on a current workforce base of 55, 60 crores is I think a very, very hard task. I don't think that will be possible. So quite a few of the underemployed or maybe the women who are not part of the workforce may never be able to enter the workforce. The question for us to ask is, are we going to create enough jobs so that we can grow at, say, 7% a year? I think so. And is there an opportunity for them to get skills? Because I have seen how, say, the IT industry has scaled from, when I joined Infosys in the year 2000, I think there were 6,500 people. In 2003, when I left to join Credit Suisse First Boston, there were 20,000 people in Infosys. So did they find skilled people? No, they caught people and skilled them. So if there is demand, I remember my first project was with a large consumer company in the US. I was the only one who had seen a data warehouse getting built. The other two who went along, we were giving data warehousing strategy advice to one of the pioneers in data warehousing. And they never seen one. But in the first 4 weeks, the client figured out that his team was shaky. So they kind of threw us out. Then we worked. A month and a half later, we went and presented, and then we got back. So a lot of the skill building actually happens when there is pressure, when there is demand, companies sort of solve the problems. So I think we have to, so while skilling is a very important problem, I think human potential, human capital build-up is extraordinarily important. The way to solve for this is not for the government to start running skilling programs, which is important. But, you read books like Invisible China, you realize that the equivalents of ITI in India, which work in China, they're equally corrupt. So this team went around looking for training agencies which were getting subsidies from the government. Many of them didn't exist. Many of them had no training, students just appeared. So they've done an excellent job in training a large number of people, but it has been done by local government, local businesses. So they've had some job market flexibility. So what we can do and should do is, the 4 labor codes that we implemented to simplify or consolidate the 44, 40, 48 labor laws into simple codes. I think the regulations need to be published. Those laws need to be enforced. Once that flexibility emerges, I think the companies will be far more willing to take on workers so that they can reskill them when needed, have some flexibility. It is frankly in the interest of the workers also. But what you have to focus on is reducing the supply bottlenecks, which are preventing firms in India to grow larger, or even from entrepreneurs to set up new firms. The rest, I think, the skilling problem, I think they'll start to solve.
So you spoke about, the large employment generating capacity of IT sector. And in fact, that has been a big boon for India. But now with this race for AI supremacy gaining strength, do you think there's concern around India falling behind? And what could be the implication of that on India's IT ITS sector and overall employment generation?
Well, that's a very important question. I think it's not just about the jobs in the IT sector, but the second, third order effects of the income generation that to happen from that. So, just to quantify the numbers, the IT sector in India employs about 5.5 million people, 55 lakh people, in a workforce which is about, I would say, 55 to 60 crores. So, there's about 1% of the employment is in the IT services sector, but they are 6% of GDP. So, so their per capita incomes are much larger. Their ability to spend, buy houses, cars, consume restaurants, schools, etc., is much bigger. So, is there going to be an impact on their demand? So, I think a few things have happened. First is that clearly some of the lowest end work can be done by AI, and that's reflected in their clients demanding 30, 40, 50% cuts on billing rates, because if say 40, 50, 60% of your code is being generated by AI. I don't think it is that high now, but it will be in the next couple of years. Then why do you need it? But I think what is missing in that doomsday kind of scenario is that the demand for software starts going up. See, you take a simple example. Suppose, we are doing a project on a very important thematic, and in that thematic, I would like a number of reports to be written. Ideally, so right now all our reports go into a portal. I would like to create a microsite which is there only for that. So if anyone who wants to research on that particular topic, say, so even if it is quick commerce, so all the reports that we write, someone wants to understand quick commerce in India, all the reports should be visible there. The reason I don't do it is that there will be a 2 month software requirement specification, then someone will develop it, then we test it, will be loaded. By the time it is done, the quick commerce is so well understood, no one wants to read about it. But if software can generate the code faster, the turnaround can be in 3 weeks, 4 weeks, and it is much cheaper. If it costs me so much money that it's unaffordable. So I think the demand for software is also going to go through the roof. So I would say that it is up to the IT services companies to again pivot. Remember that there was a phase where the Y2K boom created just data change and the date change kind of work, which then people thought, oh, Y2K is over and all these companies are going to struggle. But when that ended, because around that time the e-commerce boom was happening, so a large number of transformation projects started. When that started to end, mobile commerce and mobile apps and iPhone was launched. Today, with all the work that is happening on AI, I think large number of supply chain software, customer relationships, or everything will need to be rebuilt, and not everything can be done because a number of companies have inbuilt company software. They cannot just buy software from outside and start using them. And so all the classic problem areas which Indian IT firms dominated, I think will remain. The transitions will require a lot of work. And every time we have seen this transition, like say even the transition to cloud, opened up new opportunities for Indian firms. So I don't see this as much of an existential crisis as most people seem to be painting it as. I see this as more of a time of transition, where the old ways of doing business need to be revisited. The fact that the volume of software will rise substantially should, I think, reasonably well offset the fact that AI can generate some code. So I don't see this as a big problem. In fact, on the other hand, I think it can be an opportunity. There were certain types of problems that couldn't be solved from India because intelligence was lying there. Now, if intelligence start getting traded because you're training some models there and they can be used by people here, it can actually create new types of jobs. So even as we are seeing the IT services companies struggle with their employment, of the number of workers they have, we are seeing GCC is still hiring a lot. So net, I don't think it's as doomsday as people fear, but it will require a lot of change. If you recall, in the late 90s, there were so many companies, and today we have like 6 large companies. So and the companies that have managed the transitions that have happened have survived and thrived and grown, and it will be the same this time. So maybe some companies will be left in the lurch, and some others will actually take advantage and grow faster.
Yeah, definitely. You know what you said, GCC's share in overall services exports has been increasing, and that's very comforting. I want to talk about a different issue. As an economist, you know, what I'm very often asked is what's happening on the private investment front. So, you know, for the last few years, we have been saying the ground is set and private investment should pick up. And actually, it has picked up. But still, we are not seeing the kind of momentum we would have liked. So, what do you think is holding back the private sector? Why are they being so cautious?
So let's first look at some numbers. The most comprehensive measure of investment in an economy is the GFCF to GDP ratio, the gross fixed capital formation, which is the investment to GDP ratio. That used to be 34% in 2012. It fell to 27% in 2021. It has now bounced back up to about 31%. So it would be wrong to say that, and this is all in nominal price terms. In fact, if you look at it in real terms, what you realize is that those ratios dipped slightly and they're now kind of back to where they were in 2012.
Now, so we are not that far away from an investment to GDP peak that we saw in 2012. 2008 was slightly bigger. It was 37%, but that was an exceptional year. But after that, I think most countries have struggled. So the, the decline and the pickup, I think a large part of it has been in real estate.
Oh.
So in any economy, you see three parts in the GDP. So there is the public sector, it's private corporate, it's households. The three add up to GDP data, and this is what Mosby provides for India also. So in that 7% point fall that happened from 2012 to 21, 5% point was household investment in dwellings.
Yeah.
Now, of the remaining, so there was -5 here, there was -3.5 on machinery, and there was plus about, I would say, 1.5 combined into IP investments or government investment in structures and all like roads, highways, railways, and all that. So why did machinery fall? Where did machinery fall? Machinery mostly fell in utilities. As you know, the power sector went into a down cycle. And in manufacturing of stuff that goes into real estate, construction materials, construction machinery, metals, these were the areas where the decline happened. So if you think about it, the private capital, private capex is an outcome. It's not an input. See, most of the analysis that I hear makes it sound like that's the start of a cycle. Companies respond to demand visibility, and therefore, I think it's extremely important to manage a real estate cycle. See, the power generation cycle more or less has kind of taken off. It has slowed a bit right now because of the monetary tightening, the unintended monetary tightening that happened over the past year. Now that it is being easing, in the next 3-4 months, I expect the economic momentum picks up, and then all of those cycles will come back. I think managing real estate becomes the most important. If you manage the real estate cycle well, a number of problems start getting solved. First, this is the classic transition sector. That if you want to move people from relatively unskilled agriculture to semi-skilled, the construction is the best space. It can absorb a lot of people. Second, it accelerates demand for manufactured goods. The average Indian lives in about 130 square feet of constructed space. The average Chinese in a tier 3 city where 80% of housing stock is lives in 550 square feet of constructed space. The average American lives in 700 square feet of constructed space. So this is an incredibly strong source of demand. A lot of the manufacturing prowess of China is also courtesy its perhaps overbuild of real estate. So that I think is the only problem we should worry about. How can we manage good quality but affordable housing? And affordable housing not in the sense that it's like bare bones. What I mean is that the cost of housing increase that happens because of delayed approvals. So if it takes, even in the US, Texas has managed housing much better than California. And so as you can see, Texas is doing much better than California because If it takes 2 years to get approvals, for those 2 years, the capital is stuck and therefore house keeps getting more expensive. In Texas, and the moment you have cheap housing, you can set up cheap research centers. You can have cheap services centers. You can have cheap manufacturing because whoever you employ, they have to have access to cheap housing. So I think managing the supply of housing, making sure that approvals are fast, making sure that the delivery is fast, is the most important. Once that happens, you can see that many steel companies are already at 3.5 times the EBITDA. Cement companies are already talking about a 50% capital expansion or a capacity expansion in the next 3 to 4 years. All of them are responding to the potential growth in the real estate cycle. So I don't worry too much about private sector capex. What I do see is a bit of churn happening in the private sector itself. Operating cash flows today are far better than investing cash flows. Companies are less leveraged. They have actually deleveraged significantly. They are also seeing low cost of capital. They're also seeing low cost of debt and equity capital, low tax rates, and easing regulation. If entrepreneurs don't respond to that, they will be competed away. Meaning that if you're as a large incumbent, you are scared of taking big risk, then some hungry entrepreneur from down below is going to use this opportunity and then build a much larger business. So that cycle of creative destruction, I think, is starting. So you can see how various forms of capital, if you look at private equity, for example, today you have several firms which do buyouts or takeout. And it's basically, they will take up a company 100% stake, hire a professional CEO and management, give them 2-3% stake. And then over 5-6 years, they just turn around the companies. From that to, if you want to exit, but you don't want to IPO, there are large private equity firms which can actually take over that. So then it's a very diverse and very fertile financial system now. And I do think that M&A activity, innovation, entrepreneurship, we should see significant improvement over the next 8 to 5 years.
Neelkanth, let's wrap up this episode with a rapid fire round. So I'm going to ask you some quick questions, expecting short reply. No filters, only instinct. So my first question, if not an economist, what would you be?
Computer scientist.
Okay. Because I think you've done your engineering and computer science.
And I worked in that field. So
Okay. A superpower you wish you had?
remember everything I read.
I think you already remember a lot, but okay. A book that strongly influenced your thinking on economics?
James Scott's Seeing Like a State.
Your go-to stress buster?
A long walk with my audible.
Okay. By 2047, India will be known globally for?
It's soft power.
Interesting. What's one trend that young people follow today that you actually love?
They focus on sustainability.
Yeah, true. One word your friends would use to describe you in college?
Let's skip that one. It's a very impolite answer.
Okay. Okay. A policy idea that's not popular but should be?
Free trade.
Thank you so much, Neelkanth. And that brings us to the end of this episode of InsightEdge, a CareEdge podcast series. We had the privilege of talking to Neelkanth Mishra, economist, policy advisor, and a change maker. We had a very insightful discussion. And I am Rajani Sinha, chief economist at CareEdge Rating, signing off for now.